Hello everyone. In order to be active in the stock market, there are some jargon that you have to understand, you have to learn. So let us see some of these items, some of these jargons that you have to learn. First, market cap or market capitalization. It is obtained by multiplying the shares outstanding at the end of the year by the share price. Okay? Next, volume. Volume will be approximate daily trading volume. The approximate daily trading volume is expressed in rounded off to nearest thousands. It is an indicative figure. The trading volume below and equal to 5 will be rounded off to 5. Trading volumes may differ dramatically from day to day and during the day. Next, adjusted daily share price chart. The graph shows daily share price of the company and 100-day moving average graph. You may be showing 50-day moving average. You can select in many of these places. Next is shareholding data. The percentage of shares held by Indian promoters, foreign collaborators, Indian institutions, foreign institutional institutions, and the percentage of free float. What is important here is the free float and FII holdings. The more the FII holdings, okay, the greater the price increase. That you can really understand. If the FII holdings fall fast, then the price will fall much faster. Then equity, supposing you take equity share movement on a particular day, you will have opening, you will have a high during the day, low during the day, and then closing. Same thing is applicable for a month, for a week, any period you take. Next, sales per share. The sales of a company in a period divided by the number of equity shares will give you sales per share. That will give you performance, gross measure. Next, earning per share. Earning per share is calculated by net profit after tax divided by number of shares. This is earning per share. Then you have cash flow per share. Cash flow is obtained by adding the net profit after tax adjusted for the preference dividend to non-cash charges like depreciation. The cash flow per share is the figure divided by number of shares. Right? Next, dividend per share. This is the amount of dividend declared by the company as a percentage to its face value, calculated on a rupees per share basis. Then you have dividend yield in percentage. The amount of dividend received per share divided by average price. It is average of a high and low. High plus low by 2 will be the average of the share in a period, gives the dividend yield. Now the book value per share, it is in rupees. Net worth or shareholders' equity of the company is divided by the number of equity shares outstanding to arrive at the book value per share. Next, shares outstanding, it is given in millions normally. This represents the number of equity shares that are issued by the company as given in the annual report. Then bonus, rights, conversions. There will be various items will be there. What are they? Shares allotted on amalgamation or merger, bonus issue, buyback, bond conversion, capital reduction, debenture conversion, demerger or merger, employee stock option plans, face value of conversion, global depository receipts, global depository shares, other issues, preferential allotments, public issues, private placements, preferential share conversion, rights issue, and warrant conversion. These are all the various items that are there in equity shares, share capital. Next, let us see the ratios, different financial ratios, how you can analyze the balance sheet and others. First, foremost will be price to sales ratio. The average price of the share in a particular period divided by the sales per share will give you the price to sales ratio. Next, PE ratio, price to earning ratio. The average price of the share in a particular period divided by the earning per share gives you the price to earning ratio. Then price to cash flow ratio. The average price of the share in a particular period divided by the cash flow per share will give you the price to cash flow ratio. Then price to book value ratio. The average price of the share in a particular period divided by the book value per share gives you the price to book value ratio. Now, out of these, which one is better? Price to sales will give you how much actually the revenue, total revenue overall is being generated, how much activity is going on in that company, and then what are you paying for that. Price to book value will indicate what are the assets available with the company, and for all those assets, what is the price that you are paying. Then price to cash flow will indicate how much cash flow is being generated overall. Okay, then just after the trading account, just after the manufacturing activity. So for that, how much are you paying? PE ratio will indicate net profit after tax, after paying all the items, only basing on what you're going to pay. How much price are you paying for that earnings that are ready, available for an equity shareholder, either as a dividend or a retained earnings. So these are all the 4 items that you have to see. Next is dividend payout. Dividend per share divided by the earning per share gives you the dividend payout. Then efficiency, number of employees will be normally thousands. Then total wages and salary will be in millions. You can also, per employee, you can have total wages and salary. Then sales per employee, nowadays it is being measured how much each employee is contributing to the bottom line. The sales of the company divided by the number of employees. So that will give you average sales per employee. Then wages per employee, total wages divided by the wages of salary divided by the number of employees. So you compare the total sales per employee versus wages per employee. You will know how efficient the workforce is. Then net profit per employee. It's calculated by dividing the net profit after tax by number of employees. Then you will say how much profit, the top line, how much bottom line is contributing. Okay, sales is the top line, net profit is the bottom line. Remember. Then income data. If you want to analyze income data, first one is net sales versus gross sales. Then gross sales, then you remove returns, sales returns, you will get net sales. So net sales will be for a particular period. That will be your amount. But you have to remove non-core items and core items. Whenever there are non-core items that are there, that you have to remove and arrive at it. Then other income may be from investment, other income from maybe from other activities or sales of assets, sale of any one-time items or incentives given by the government. So such things also you have to adjust for it. Then you will get, after trading account, you will get a gross profit. It is the profit earned after taking into account the operating expenses of running the company, raw material cost, administrative cost, direct overheads, interest, but this will be before the paper entries like interest, depreciation and tax. Then depreciation, it is the amount of money set aside for future acquisition of plant and machinery, which will be useful for, if you have more depreciation money that is there, then it will be good for you to acquire new machinery. Then interest is the charge paid by the company for the loans it has taken from banks, suppliers, depositors, shareholders, and including bank charges if any. Okay, so this is the interest. So many times companies go all around the world shopping for lower cost of loans just to overcome this interest burden. Okay, interest burden becomes very, very important when the interest and the loans taken are high. That means leverage is high. Then profit before tax. Profit before tax is, PBT is the profit of the company earned taking into account the expenses like cost of raw material, interest and depreciation. Then extraordinary items is the income or expenses are non-recurring in nature. Tax is the tax paid by the company on its profits. Profit after tax, profit before tax and profit after tax together with tax will indicate what is the tax, what is the amount or the work that the company is doing for the government. That means not doing for shareholders, it's working for the government. Then gross profit margin, effective tax rate and net profit margin. These are the items that you have to see. Okay. Then next talk we'll talk about balance sheet. Thank you.